This LOS is describe the relationships among a bond's holding period return, its duration, and the investment horizon. Investment horizon, Macaulay duration, and interest rate risk. When interest rates rise, duration measures the immediate drop in value. In particular, the money duration indicates the change in price. Then as time passes, the bond price is pulled to par. The gain in the future value of reinvested coupons starts small but builds over time as more coupons are received. Okay? The curve indicates the additional future value of reinvested coupons because of higher interest rates. At some point in the lifetime of the bond, those two effects offset each other, and the gain on reinvested coupons is equal to the loss on the sale of the bond. That point in time is the Macaulay duration statistic. So on the other side, when interest rates fall, it leads to a reduction in the bond yield and the coupon reinvestment rate. There is an immediate jump in the bond price as measured by the money duration, but then the pull to par effect brings the price down as time passes. The impact from investing at a lower rate starts small, but then becomes more significant over time. The loss on reinvested coupons is with respect to the future value if interest rates had not fallen. Once again, the bond's Macaulay duration indicates the point in time when the two effects offset each other and the gain on the sale of the bond matches the loss on coupon reinvestment. So this is the most important slide for this LOS. We have a statement of the general relationships among interest rate risk, the Macaulay duration, and the investment horizon. 1, when the investment horizon is greater than the Macaulay duration of a bond, coupon reinvestment risk dominates market price risk. The investor's risk is to lower interest rates. The duration gap is negative. I put that in bold red. When the investment horizon is equal to the Macaulay duration of a bond, coupon reinvestment risk offsets market price risk, and the duration gap is 0. When the investment horizon is less than the Macaulay duration of the bond, market price risk dominates coupon reinvestment risk. The investor's risk is to higher interest rates. The duration gap is positive. Okay? So you absolutely have to memorize these three relationships. Investment horizon greater than Macaulay duration, it's the coupon reinvestment risk dominates the market price. Okay? So your risk is to lower interest rates, the duration gap is negative. If the investment horizon is equal, it's offsets and 0. That should be an easy one to remember. And so it's then if the investment horizon is less than the Macaulay duration, it's the market price dominates. So your risk is to higher interest rates. Rates go up, price comes down, and the duration gap is positive. So we're just going to finish this LOS with 2 practice questions. The first one, the holding period for a bond at which coupon reinvestment risk offsets the market price risk is best approximated by A, duration gap, B, modified duration, or C, Macaulay duration. Okay, this question is very interesting. I often say the CFA exam is English test subject, in this case, fixed income. And so you have to be very careful reading the question and specifically the words. So this question was asking for the holding period for a bond at which the coupon reinvestment risk offsets the market price risk. So we're not talking about the duration gap, okay? The duration gap is 0 when the investment horizon is equal to the Macaulay duration of a bond, and the coupon reinvestment risk offsets the market price risk. But I put here in bold at the top, in green, is that at some point in the lifetime of the bond, these two effects offset each other, and that point in time is the Macaulay duration statistic, okay? That's the holding period. So when it says holding period, it has to do with time. So C is correct. When the holder of a bond experiences a one-time parallel shift in the yield curve, the Macaulay duration statistic identifies the number of years necessary to hold the bond so that the losses or gains from the coupon reinvestment offset the gains or losses from the market price changes. So the duration gap is the difference between the Macaulay duration and the investment horizon, okay? And modified duration approximates the percentage price change of a bond given its change in its yield to maturity. So an interesting question, read it carefully. It's talking about the holding period, time, and that's the Macaulay duration statistic, okay? And we'll just finish this LOS with one last practice question. When the investor's investment horizon is less than the Macaulay duration of the bond she owns, A, the investor's hedge against interest rate risk, B, reinvestment risk dominates and the investor is at risk of lower rates, or C, market price risk dominates and the investor is at risk of higher rates. Okay, that's why I said the one slide with the 3 general statements is the most important, because you can see this question is just based exactly on memorization of those statements. So let's just do this. This is the last slide for this LOS. So a quick little review. I copied and pasted from that slide the statements. So when the investment horizon is greater than the Macaulay duration of the bond, coupon reinvestment risk dominates the market price risk. The investor's risk is to lower interest rates. The duration gap is negative. When the investment horizon is equal to the Macaulay duration of the bond, coupon reinvestment risk offsets the market price risk and the duration gap is 0. And when the investment horizon is less than the Macaulay duration of the bond, market price risk dominates coupon reinvestment risk. The investor's risk is to higher interest rates and the duration gap is positive, okay? So you need to come up with some kind of cue card, flashcard to memorize that, because you can see you get most likely, least likely. The question could be about the duration gap. The question could be about the risk to higher or lower interest rates, most likely, least likely, or coupon reinvestment risk dominated the market price risk, or the market price risk dominating the coupon reinvestment risk. So again, lots of memorization for the CFA level 1, but if you've done that, then you read this question, oh, investment horizon less than Macaulay duration, then we know it's just straight out of the bullet points. Market price risk dominates. The investor is at the risk of higher interest rates, and that's it. And don't forget the duration gap is positive. Okay, so a very nice question, not too difficult if you've done the hard strokes in terms of memorizing the general statements. And that's the last slide for this LOS. Thank you.